Hello traders, welcome back to another episode of Forex Trading. In this video tutorial we will learn Forex trading fast, how the Forex market works, and successfully place your first Forex trade in 2 hours.
So when you're trading Forex pairs, you're going to see a quote, right? That's the quote for that pair. But there's also an important concept which is called spreads, because your actual buying and selling of Forex pairs is using the spread. And so let's talk about spread and why there is a spread in the first place. So the spread is basically the difference between the buy and sell prices quoted for a Forex pair. You have a quote price, but what you actually buy and sell at is at the spread prices. So for instance, let's say the buy price on a euro to US dollar was 1.7645 and the sell price was 1.7649. And that spread difference is like 4 pips, right? So the quote price might be at 1.7647, for example, but what you could actually buy it at would be at the 4.5, or what you could actually sell it at if you wanted to make a sell bid on it would be at the 4.9. It would be the price difference in there. So that's the spread. You're buying and selling at the spread price. So if you want to open a long position or buy the buy price, that's going to be slightly above the market price or the quote price, right? If you want to open a short position or you want to trade basically at the sell price, that's going to be slightly below the market price. And the reason you have this is that the spread is basically the cost of the trade. To actually process trades and all that, and how your brokers, your online brokers make money, is they make money on the spread. They have other fees and things too to watch out for, which we'll talk about at the end of the course. But basically, the spread is the cost of actually doing the trade. So when you're actually buying and selling and you're doing these positions, you want to be looking at those spread prices. And we got an example trade here at the end of the course too, and we'll show you that too, how that works when you're buying. But for now, the thing to keep in mind is that I'm going to buy at the spread price, I'm going to buy at the buy price, I'm going to sell at the sell price. That's the main thing to understand, and there's a variance between them. And oh, by the way, the spread can be narrower or wider, depending on various factors, and one of the important ones is the liquidity of the pair, right? So a major currency, a currency pair, might have a smaller spread than one that is less liquid or less frequently traded, might have a wider spread. So they're not exactly the same. They're not all going to be 4 pips. They will vary, and they'll vary as far as between these currency pairs. So when you're trading, just keep in mind that you're trading based on spreads and whether you're buying or selling. So when you're trading Forex currencies, you're in effect trading them in what are called lots, right? That's your quantity amount is the amount of units of currency you're doing, and that's called a lot. So a lot is simply batches of currency used to standardize Forex trades. So there's standard amounts that are used when you're trading Forex, and these standard amounts are called lots. In fact, the standard amount or the standard lot is actually 100,000 units. So when you're trading a unit of currency, dollars, euros, or whatever, a standard lot would be 100,000. Sometimes they refer to them as a 1.0, and then there's an amount associated with that. For example, like $1 per pip. Remember, a pip is our 4th decimal place typically. It's a $10 movement per pip when you're trading at a standard lot of 100,000 units, right? So a standard lot is 100,000 units of the currency. So for example, $100,000. So what many people are trading, they're trading standard lots, for example. Okay, so at this point you should be saying, wait a minute here, I don't have $100,000 or pounds or euros or whatever to place on every trade. That seems like a lot. Well, it is a lot, but that is where leverage comes in from Forex trading. So when we get the Forex section, that's where we'll talk about how you can actually control 100,000 or a standard lot with a very small amount of money. But you can use leverage to do these standard lots. Otherwise, you do have alternatives, and it will vary by broker as far as what they offer, and maybe it varies by currency pair as far as what your options are. And one option is a mini lot or a mini Forex lot. Great way to get started with lower amounts and either low amounts of leverage, or maybe no leverage at all. And it's very common with most top Forex brokers. And you're then looking at 10,000 currency units, not looking at 100,000. So that'd be typically like $10,000, 10,000 euros, whatever it would be. So it's a lot of times it's referred to as a mini lot, but that's still a significant amount of money to put in one trade for sure, right? A mini a mini lot. So maybe you want to look at a micro lot, and that's a smaller step down on the trading ladder again. So that's 1,000 currency units. So that in this case would be 1,000 US dollars or 1,000 euros, 1,000, whatever the currency unit is. And so with micro lots, that's a nice easier step, but they're not necessarily available with all the brokers out there. Some are more accessible than others. So if you're looking at an online broker, that might be something to look at to see what types of lots they offer. Is it just standard or mini type lots, or do they actually go down to a micro lot? And for the pairs that might interest you. So that's something to look at. And that provides an excellent stepping stone for those who maybe have tried an even smaller amount called a nano lot and want to move maybe from a demo account or a small nano amount to committing more money to a Forex lot or bigger Forex trades. And then the smallest lot, as mentioned there, is the nano lot. And that's comprised of 100 currency units, which is total value of $100 in the case of a U.S. trading example. U.S. Nano lots are rare to see, but certainly still available with many top Forex brokers. And that's a great starting place if you're coming right out of demo or paper trading. You want to start trading small amounts so you can do more trades, smaller amount with more trades, maybe not having to use leverage at all because it's a smaller amount, or you can start playing around with leverage. It offers real money beyond just the trading account. And so it's got a smaller level of risk because you have a smaller amount of money and you can spread that out amongst many trades. Let's say you have $500 and you're all doing nano lots. Well, then you can have 5 different trades there. So sometimes you'll see lots described in decimal terms, by the way. We saw that in the chart. So 1.0 would be a standardized lot. And then it breaks down to these mini and micro nano lots, 0.1, 0.01, 0.001. So you'll see them described that way as far as these different lot types. So typically, as you gain more experience with trading, and willing to take on more risk, and then that's when you're more likely to take on bigger lot sizes. And so again, just really recommend that starting with paper trading or a demo account, using that fake money to practice, and then you can start moving up to nano or micro lots depending what's open for you there from the different brokers. The other thing too is brokers prefer to trade in standard lots when they're using this. So they may have loyalty or active trader or rebate programs, and so they'll give you some money in effect. Take a look at that if they're offering kind of specials. But a lot of time these are based on standard lots that you need to trade a certain amount of standard lots to do that. And again, you can use leverage to get up those standard lots. You don't need to have 100,000 in your currency. When we come to the leverage section, you'll see you can control a lot more by using leverage. So there's some terminology for you as far as understanding. In Forex, when you hear somebody saying, I'm trading a micro lot or I'm trading a standard lot, then oh, they're just talking about quantity, really. So now that we understand more about how the Forex whole market works and how Forex pairs work and how they're priced and all that and the spreads and all sorts of stuff, now let's talk about, well, how do we pick our pairs? How do we analyze and make decisions based on these pairs and decide what we want to trade and how to go about actually analyzing and deciding what to trade? And there's 2 big schools of thought when it comes to trading a lot of securities, like the stock market uses the same kind of concepts, crypto as well. But particularly in the Forex market, there's what are 2 big schools, and that is fundamentals or fundamental analysis and technical analysis. A lot of times that's also known as charting. And so fundamental analysis is really looking at bigger, broader events, economic calendars, news, what direction economies might be heading, looking at the fundamentals. And then technical is really looking not as much at that, and really looking almost exclusively at like charts and patterns and things that might be happening in the market and trying to trade based on those movements that's happening in the market. So with both fundamentals and technical analysis, and like most financial markets, Forex prices are primarily driven by the forces of supply and demand, right? The traders in the market set the pricing, right? I'll give you so many dollars if you give me so many euros. So that's a trade, and we agree on an amount as far as that would go if we were just trading, I don't know, at the local coffee shop. This is all happening with, millions of trades, all billions in an hour. And so, but it's all based around that supply and demand, and the traders are setting that market price as far as that supply and demand. So if we look at, for example, let's just take US dollars, and let's say the demand for US dollars is increasing. People say, oh, I want to buy more of that US dollar. That looks good. There's more demand. Well, there's only so many dollars in circulation, unless the government prints money, which we'll talk about how central banks can do stuff like that. But if that remains the same, as demand increases, the supply is going to drop, right? So there's only so many units out there. So increasing demand, increases, the supply will drop with that. And by the other side of that is, if people are saying, oh, I don't want dollars. Dollars are horrible. They're going down. Their value's going down. So I wanted to, we don't want dollars, right? So the supply will increase because the demand has dropped. There's less demand, so there's more supply available, and pricing basically has dropped to meet that. And that's what happens is, if you think about it, when there's demand increases and the supply is less, like with anything, that means the prices are going to increase, right? If you're buying a commodity of some sort, like wheat, and there's a lot of demand for wheat, but there's just not much wheat out there, well, the price of wheat will go up in price in the commodity world. Same with currency world or Forex world. High demand, lower supply means the price increases. The opposite, low demand, supply increases, so to meet that, the price needs to decrease. So it's all based on the idea of supply and demand, prices increasing or decreasing. And that's where fundamentals and technical analysis is looking at what might be the causes or the opportunities, or what might be an indicator saying which way something is going to head. Is it going to go up in price, or is it going to go down in price? And that'll help us make our choices. So let's talk more about fundamental and technical analysis in these next lessons. So in fundamental analysis of the two schools, fundamental and technical analysis, a good way to think about it is that something big is going on. Something big is going on, maybe, let's say, in the economy of a currency, for example, or there's some type of news announcement or some type of government policy change. Something's happening to cause the prices to move, either up or down. And as a trader, we're looking at that, what we might be having feelings or thoughts or research around an analysis, and we're going to talk about that. As far as, well, which direction is a currency pair going to move, up or down, and then we'll trade accordingly. And we're going to look at the fundamentals around that when we're looking at fundamental analysis, which is different than technical analysis, which is coming up. So a big part of fundamental analysis is looking at what the central banks of countries do. They can have a real outsized effect on the currency of their country and whether it's going to go up or down. And here's some examples of different different central banks out there. One that's known, like the U.S. Federal Reserve, is commonly known as the Fed, for example. But you can see we have all sorts of different types of central banks out there in all these different currencies and all these different countries. And they make policies that can impact currencies dramatically. And let's look at some of the policies they could do. One that we've seen some more recently, or in the recent past, is quantitative easing. For instance, which basically involves injecting more money into the economy, right? They're just going to basically inject more money in the economy, and that causes a currency's prices to drop, right? Remember, we're back to supply and demand. There's more supply without there being an associated increase in demand. And so with that happening, without that increase in demand, it's going to cause the price to drop because it would stay the same. So that can cause prices to drop. Another big thing you'll see is central banks control the base interest rate for their country's economy. So by changing, you might hear them say, like, oh, the Fed raised interest rates, or this central bank lowered interest rates. That makes a difference in what happens with the currencies. So if you purchase an asset in a currency that has a high interest rate, for example, you can get higher returns, right? So I'm buying something like a bond that has higher interest rates because the central bank has raised interest rates. So when that happens, investors will flock to that country that has recently raised interest rates, in turn boosting its economy and driving up the value of its currency, right? Because money is now flowing into that. However, high interest rates have a downside too. They make borrowing harder, in particular in that country. So if it's more expensive to borrow, investing is harder, and currencies, currencies may weaken. So it could, one of two things could, happen basically with this. So it's not necessarily obvious which way it might happen, but it definitely, like if we're looking at the stock market, for example, higher interest rates tend to put a drag on the economy and put a drag on the stock market. But fundamentally, we're watching what's happening with interest rates. So with that, you might say to yourself at this point, well, why would a central bank want to intentionally raise or lower its currency value? Why would they want to do that? Well, first off, they may not be intentionally actually looking at the currency itself. That's more of an unintended consequence or an intended consequence or a byproduct of their decision making. So it may not actually be currency related. So we were mentioning interest rates is a tool that central banks can use and the government can use to manage important things for their citizens, like, let's say, inflation, right? Inflation is basically if your prices go up too fast, let's say your price for bread or milk, for example, if things are going up too fast in prices, you can raise interest rates to slow the economy down, to slow companies will borrow less money and keep money flowing into the economy is, the bigger picture behind that. But the idea is that they can use interest rates to help reduce the growth of the economy, to kind of manage it better, and reduce inflation is the goal. They're trying to reduce inflation or rising prices. Another thing that interest rates can be used as far as with unemployment, real important to the citizens of the country, right? If you have too many unemployed out there, you can lower interest rates to make it easier for companies to borrow money. Their money will go farther, basically. And as part of that, maybe they'll hire some workers or expand their operations, resulting in hiring more workers, thus reducing the unemployment rate and more citizens have jobs. So it might not be related to currency at all when they're changing interest rates. It might be particularly if central banks look at inflation and unemployment. Or it might be exactly the reason why they're doing it. It might be 100% currency related. Maybe they're looking at international competition, exports and imports. A lower currency value attracts foreign investment. If I can invest in lower amounts in one currency, and my currency has more value, but I'm investing in things overseas in currency that has lower value, that can be attractive to me as a foreign investor. Sometimes I can get into unfair trade practices. China certainly has been accused of unfair currency manipulation just for this reason, to make it more attractive to invest or have companies, let's say, open operations or open plants or relocate things to China. And so they do that by, some would say, manipulating their currency. I'll let you decide that. But that's the idea behind it. They can do that by making China more attractive to foreign investment by impacting the currency. Also, citizens traveling abroad. If you have a stronger currency, your purchasing power will go further when you're traveling abroad, right? So that's the central banks. Another thing with fundamental analysis you want to be aware of is news reports. So a positive piece of news hits the markets about a certain region or certain country. It will encourage investment and increase demand for that region's currency, right? The economy's doing better, people want to invest in it, so they'll impact the increased demand for that currency. The opposite, of course, is bad news or negative news can cause investment to decrease and lower a currency's price. So a couple of real important things that you'll be watching for with news reports. We were mentioning inflation, watched real closely by central banks. So watching for reports that might be indicating things that inflation is rising or coming. Certainly if there's any official reports around the CPI, which is also known as the Consumer Price Index, which is an inflation measure, you really want to be aware of that from a fundamental analysis. Or things are happening in the overall economy, like the GDP or gross domestic product. And other things too that could be, just general news reports, industry production reports, retail sales, employment and wage reports, international trade deficits, are there deficits or surpluses, or news reports around geopolitics, things around tension or wars or things like that. These are all things that can impact a currency up or down and to be aware of. Now, how to be aware of those is out there are a lot of different types of economic calendar resources out there. So you can kind of get into these resources. I've listed like 4 here that are very commonly used. Go check them out. And you can see what's upcoming as far as different news announcements or different types of things that might be coming on the economic calendar. So maybe the central bank is going to make their quarterly announcement or their monthly announcement around interest rates. You want to be aware of that, and maybe you might not want to have a position even open because you're not sure which way interest rates will go. So you might want to be out of the market at that moment, as an example. But here's some economic calendars you can take a look at and kind of plan your trading around that. Lastly, you have what's called market sentiment, which is often just the reaction to the news and can play a major role in driving currency prices. If the market sentiment, a lot of currency people or traders believe that it's just going to head in a certain direction, that supply and demand is going to basically follow suit, increasing or decreasing demand. So a lot of times you might hear articles or news articles or stories about, oh, the market sentiment is this. That's just an idea where people are talking about, based on a lot of what's happening in the market fundamentally, that might be the direction a currency is heading, up or down. The second school of looking at how to evaluate or analyze currency pairs is with technical analysis. And a lot of people refer to it as charting because you're really looking at charts and trends and movements and things to make decisions on. So it's a little different than fundamentals, which is a lot about what are central banks doing and what is in the news. Technical analysis is really looking specifically at these individual pairings and seeing what has been happening with them and looking for indications, or what's called indicators, to see what might happen next, and then you trade based on that. So let's talk a little bit more about technical analysis. So technical analysis is even more focused on the movement of that supply and demand, I'd say even more so than fundamentals. And it's really the kind of the concept or idea that the supply and demand and the price movements, in particular what we're looking at is price movements, can be measured and predicted, and is the idea. Now, nothing's foolproof, of course. Nothing works 100%, but it's been around for a long time and is used in stock markets and cryptocurrency. Technical analysis is used in many areas. In fact, I think it lends itself very well to currency pairs because it's so much, around that whole movement of prices versus, let's say, stock market works great for stocks, but you have underlying values of companies and things. And you have the same thing with currency where you have underlying, economies and values too. But so technical analysis works everywhere, but I think it works really well for currency pairs. And technical analysis uses indicators or tools to help predict, price movements based on kind of the past successes of these indicators or tools that are being used. And really what you're looking at is you're looking at for trends. Are prices headed in a certain direction, maybe an uptrend? Are they headed in a downtrend in a certain direction? Are they kind of moving up and down or sideways? So you're really kind of looking at trends. And there's many different indicators out there. I actually have whole courses around technical analysis indicators, run over 12 hours in length. And certainly advise you to take a look at some of those courses. But that's the big idea around that, is that you're looking at these different indicators to look at trends and what might be happening next. Let's look at a couple indicators so you get an idea of what we're talking about. We're going to look at moving averages, and we're going to look at overbought and oversold situations. Using this charting or technical analysis, I'm going to walk you through an example, and that way you can get a feel for it and see if this type of analysis is for you. And if it is, then you might want to take some more additional learning to really learn technical analysis. Would be a good thing. And I have courses, love to see it in one of my courses, of course, but if not, you want to learn more as far as technical analysis. So let's take a look at an example. Okay, here's an example using the euro to the Canadian dollar, right? So we're looking at euros and Canadian dollars. And so let's read this chart and let's apply some technical analysis to this. So first thing, starting in the upper left, it tells you what we're trading, right? We're euros to Canadian dollars. The chart, by the way, where it says 2H, that means it's based on a 2-hour chart. If it said 1D, it'd be a daily type chart, or it could be a minute chart. You can change your time frames to make how frequently you want to trade. If you're a day trader or trade a lot, you'll be looking at maybe minutes and hours, versus somebody who maybe is trading over days and weeks. You'd look at different charts then. So then you see your prices, right? In the red is the sell price, and the blue is the buy price, and then that's your spread. And you can see that middle number there at 0.4, that happens to be the pips, but you could look at the two different numbers and see that's the pip difference. But really what we're going to look at with technical analysis is the chart itself. So if we look at the top there, you see that blue line, that's an indication of the pricing of that pair, euros to Canadian dollars. On the far right is the actual pricing. But the main takeaway is that as time goes by, left to right, the pricing is constantly changing, and the blue line graphically represents that. So the blue line is representing the market or quote price for the euro to the Canadian dollar. And you can see it's a squiggly line. It goes up sometimes and goes down sometimes sharply down. So that's how, if there was nothing else in the chart, that's what you would be looking at. But we're going to apply two technical analysis indicators against this chart to see whether we should buy or sell. So the orange line that you see going across at times the blue line, that is the moving average. So that is the average of the prices going back, in this case, like over the 9 periods, or 18 hours, because it's a 2-hour chart. So you're basically looking at what is the averages and how is that moving average, going or looking back at time. And that's going to tell us something about, when the blue line crosses the orange line, that's going to give us an indication whether to buy to sell or sell. And we're going to look at that in just a moment. But that's what the orange line is the moving average, and the blue line is the actual euro to Canadian dollar. And then below is another technical analysis indicator called an RSI, or relative strength index. Don't worry about understanding what's all involved in RSIs. Right now, just to know that an RSI gives us a measure of whether something is overbought or oversold. And it's kind of what's called a momentum indicator. So is it gone way up in price fast and then now it's ready for a downtrend or what? So you're looking at how to read that is if it's above 70 or approaches 70, you can kind of see in the purple there, that means it's more of a overbought position. It might be right time to sell. If it goes below or start approaching 30, then it might be an oversold position and might be ready to rebound or go back up. And if it's really in the middle, then there's, you can't really tell either way with at least with an RSI. It's not giving you a clear indication. Okay. So let's analyze this a little bit. I want to direct your attention to this one point here. I kind of put the black arrow, matching up these two things. And so a technical analysis person, at least looking at when the prices were at this very moment in time where that black arrow is, when the blue line, the Canadian, euro to Canadian prices go below its moving average and crosses the moving average, that's an indication that a downtrend might be starting to occur, and that's a sell signal. Again, nice thing with Forex, you can buy or you can sell. So this would tell me that if I owned this pair, I might want to close my position, or if I want to put in a sell order, this might be saying, okay, we might be headed a downtrend, this would be a great time to sell, and then when it keeps going down, we can, that's where our profit would be, right? Versus, let's say, buying and wanting the line to go back up. Same thing where if you look at this RSI, see how it's got near 70 there? If it would have gone way above 70, that's even more of a sell signal. But at least since it's close there, and then in combination with that moving average line, these are both sell signals. And as you can see, what ended up turning out afterwards as time goes by, left to right, you can see how the blue line keeps going down or the prices keep going down. They keep going down, and then it starts to kind of go sideways in the middle where it goes above and below the line a little bit, that orange line, and then goes back down again. But you can see as the prices keep going down, see how the RSI is going down as well. It's not as big an oversold, or excuse me, overbought position. So you can kind of see its movement that way. Where if you look before where the black arrow is, see how it had this big uptrend and really was kind of spiking up there a little bit and really had that nice tall peak like a mountain, like that tall peak of the mountain, and then started to come down sharply. So once it crossed that orange line, we had a high RSI near 70, almost over 70. That's where I would say, oh, okay, it looks like we're, the momentum has changed. It's a sell signal. So that's the idea by looking at this example pair and applying charting or technical analysis, where you could look at it and say, oh, if I just analyze the charts and things, this could tell me stuff, give me indicators, and sometimes it's time to buy, and sometimes it's time to sell, but many times it's time to do nothing, right? Because there's no clear indication. And that's the idea of technical analysis or charting. It can be used in conjunction with fundamental analysis as well, too. It might help explain when there's some market sentiment or there's overbought or oversold situations, whatever there might be. Again, I have 12-hour courses just on technical analysis, and so that's something if you're interested in, check that out, and learning more about. But that's how it could be applied to Forex. One last great news, too, about technical analysis is that once you learn the concepts, you can apply technical analysis concepts to any type of market. So whether you're trading commodities or the stock market or cryptocurrencies or Forex market, the concepts like we just learned talking a little bit about moving average crossing over that line or the relative strength index, whether it's a 70 or 30 and what to do, buy or sell, those concepts apply no matter what type of security that you might be trading. So the great news is that once you learn it, and you want to trade other things to diversify or whatever you might be interested in, that's great because you can apply those concepts universally. So it's a great reason why a lot of people like technical analysis. So there you have fundamental analysis, technical analysis, two ways to evaluate and analyze and looking at the Forex market. So let's talk about some steps to get you started and get you going towards your first trade here and kind of the progress how you would do that. So first step is to do what you're doing, which is to learn how the Forex market works. So finish the course. We're almost done here. So do that, and then also think about investing more of your learning in certain types of things, particularly like technical analysis. If that was interesting, then take a technical analysis course from me or from whomever. So the first thing is continue your learning, right? So you're continuing learning. That's the first step. And then the second step is you want to develop your trading plan, and think about some of these kind of bigger, broader ideas of like, well, how much total money do you want to invest, right? How much do you have available to you that you want to invest, and how much of that do you want to invest in the Forex market, as an example? Think about your plan. Like, did you really like fundamental analysis? Did you like technical analysis? Do you want to do a little bit of both? You can do that. That's perfectly fine. You can trade on news and look at that, and then also use things like these overbought, oversold positions, whatever, to kind of use in conjunction. Technical analysis a lot of times can help explain what's happening fundamentally too. But decide how you'd like to trade with that. And then decide how much time you have available for trading is a good concept too. Are you a part-time trader that wants to trade maybe more major pairs, get in and out, or basically trade when you have time? Or do you want to be more of a day trader and be looking at a lot of different pairs, maybe even using leverage and getting in and out quickly and closing all your positions by the end of the day? Those types of things you can look at as far as your trading. The good news is the concepts around trading, especially like with technical analysis, can apply to any time frame, just a matter of how much time that you have to devote to it and want to devote to it. And if you decide you want to go one direction, I want to be a part-time trader, and then all of a sudden it's like, wow, I really love this, I could do this as my job. I want to be a day trader now. You can certainly do that, or start slow and start small and then grow from there. It's all up to you. But initially starts deciding some of these trading plan ideas of how much do you want to invest, fundamentals or technical analysis, and how much time is available to you. That's a good step 2, and can be done pretty quickly. Step 3, where I'd like you to invest a little bit more time in, is that paper trading we talked about through the course. Paper trading for free, trying stuff, seeing what's working for you, what's not working for you, that you're understanding all the different types of orders and different ways that you can do stuff. So do emphasize, do that paper trading, whether you're using a free platform like TradingView with lots of ads once again, or you found some online Forex brokers that might interest you, and they have a paper trading or demo account. Well, then try them out. You can always change your mind. You don't have to go with them. Try out their paper trading account. So spend some time paper trading and getting comfortable. That's real important, to start getting comfortable. So that was step 3. Step 4 now we're getting serious, right? Now we're going to open a trading account with an online broker. Review that lesson we talked about some of the considerations around online brokers. Things like fees and costs. Do they have the currency pairs that are available to you, particularly your home currency, of course, and that user interface? It can be very important too. Let's talk a little bit more about fees and costs right now too here in step 4. So we know that one of the fees and costs is the spread, right? So that's between the bid and the ask prices, or the buy and the sell prices. That's your spread. And a lot of times they'll just indicate that for you. Like here is euro to US dollar, and it's a 0.3, or something that's on the 4th decimal point, or something like a 200 pip for like dollars to rupees, as an example. Whether it's paper trading or live trading. So a lot of times they'll just show you that in pips what the spread is, so you understand and start practicing that with buying and selling. But other costs that are out there as well, when you'll see a lot that's for Forex is what's called Tom Next, right? So Tom Next is basically short for tomorrow next day. And it's basically a short-term Forex transaction that enables traders to simultaneously buy and sell currencies over 2 separate business days, tomorrow and the next day. So the idea is when you buy a commodity or you buy currency, that you take possession of it. So the idea of Tom Next is to prevent traders from having to take physical delivery of currency while still being able to keep their Forex positions open overnight. So it's kind of an overnight fee or a cost of carry fee. So when you look at your brokers, just look at their Tom Next fees, or take a look at Tom Next fees. A lot of people open and close their positions the same day, and they don't carry anything over. But if you want to have the ability to carry over, there's some fees that might be, or fees that are associated with that, and that's called a Tom Next fee. So somebody doesn't show up your door with an armored car full of euros or whatever, right? So there's Tom Next fees. In addition, you might have an overnight administration fee that the broker is charging in addition, and that's a small fee in addition to the Tom Next. So you might see both there. Very common to see both, actually. Also, there might be a currency conversion charge to convert to the base currency you're using on the account. So when you open your account, you have your home currency, your base currency. There might be a charge for conversion of these currencies. Again, paper trade with that online broker, you'll start seeing how that all kind of works. Some might have an inactivity fee. Some inactivity fees may you haven't used the platform for a year or 2, right? So they're not something where you're having to trade all the time, but just be aware there might be inactivity fees and then other miscellaneous fees that you might have out there. But the main fees you're going to be looking at is the spread, and then Tom Next and overnight admin fee, and maybe a currency, and a currency conversion fee. Those would be the main fees when you're out evaluating brokers, in addition to the user interface and other things as far as that broker. Step number 5, well, big day, get to place your first position, your first trade. So I would recommend that you've done your paper trading, you've gotten comfortable, going to make your first trade, start with small amounts. Don't leverage if you don't want to, or start with a very small leverage. I'd almost say start with no leverage, just to get started, depending on what your broker offers you. But start with small amounts. In fact, a good trading rule of thumb that a lot of people use is that no single trade is greater than 2% of your total available to invest. So it's less than 2% of your total trade. So if I have $10,000, and whatever 2% of that would be, was that $200, would be a single trade on there. And then with leverage, I could always, in effect, have exposure to more. But the idea is that we don't want to put everything on one currency pair, especially if we're starting out. We want to have multiple currency pairs so that we're, and not everything has to be invested at all time too. You're kind of picking your spots is the idea behind it. So a good way to get started and doing your first trade, start small amounts and keep it less than your overall total position or your total you have available for trading. And then you can always increase that to be higher and exposed to more leverage as you get more experience. So there you have it. Those are kind of 5 good quick steps as far as how you might progress to becoming a trader in the Forex market here. So finishing up your learning, that's step 1. You're almost there, and so keep going. We're almost done here for this part of the course, and let's move on to the next lesson. All right, big time, your first trade. Let's talk a little bit about your first trade and opening and monitoring and closing your position of your first trade and other new trades, and kind of look through the mechanics a little bit about how that all works so you can start feeling comfortable with your first trade. So what you'll see, as we know, is with the spread, you'll see a buy and sell price listed, depending on your broker, how they do it, but it might say bid, ask. But the idea is you're going to see a buy and sell. And then, of course, you hit the buy button for a long position to buy, or sell, open a short position, hit the sell button. And then you decide the size or quantity of your position, whether it's a standard lot or a mini lot or whatever size, you're going to decide the size. And it doesn't show here in this image, but you would also decide if you want to use leverage or not, right? And how much leverage and what your margin requirement would be around that. So that'd be a consideration. Next, you have the actual type of order. There's different types of orders out there. The most common is what's called a market order. You're basically paying the market rate, what's quoted there. But there's different things you could do to make, adjust those different types of orders as far as, the buy and the sell order. So you want to choose your order type, and you can look into that further as far as different order types beyond just the regular old market order type. And then you can add some automation into this too. Here you can see in this example, where it says take profit or stop loss, and then you can put in numbers there around a pips or a price target. Happens to be for me in dollars, it would be a different currency for you as far as different targets or whatever it might be, or percentages. So what these are, stop loss and take profits, are things where you can automate, have automated orders happen. When you make your first position, when you open a position, you can also add this automation with a stop loss or take profit. Let's look a little closer at that here real quick. And this is a nice little graphic from actually eToro, which is an online broker. They do crypto and stocks and Forex, so they do a lot of stuff. A big mobile type presence. They're like 140 countries, so depending where you live, you might be able hook into eToro if you want. I'm not endorsing them in any way. I just think they have a nice graphic for stop loss and take profit. So let's look at this graphic, what we mean by this type of order. So let's say in the far left there you see where it says buy, right? So this person wants to buy a particular pair, right? They're going to buy some pair, and so they place their order, a market order to buy. At the same time, they can place a take profit or a stop loss order, or both, or neither. They don't have to do any of this. They could just do the buy. But if they were to place a take profit order, that's putting in some automation so that, let's say the pair rises in value to the point where you'd want to sell or take your profit, basically, then you have that all preset in there with a preset target amount, for your take profit. So you don't have to be constantly watching it. If it happened to real quickly rise to that point, the online broker would have it all automated, and they would just, basically close your position for you because you told them to, and to take that profit. So it's all automated is the idea of putting in a take profit. The other one that's also very important for managing your risk and managing your downside potential is what's called a stop loss. It doesn't prevent losses, doesn't stop them, but actually the idea is that it prevents from losses going too far. So you see where you bought, where you buy, you place below that, maybe a little bit below, maybe a little further below, you put a stop loss order. So if it goes past your what you bought it at, and you're going to lose money, but you don't want to lose a ton of money to avoid some massive losses, you can put in a stop loss order to say, okay, if it goes down below this certain price target, then I want it to automatically sell because I can't watch it all the time, or I'm not watching all the time. I just want to make sure this is all automated. So that is the prevent or to protect you from bigger losses. This is the idea. So you place your buy order, you could place a take profit. So if it hits there, you automatically get your profits, or you could let it ride and not place a take profit order, or to avoid your downside, putting in stop loss orders to avoid big losses. And usually most people, and I would recommend always putting in like a stop loss. You want to protect that downside a little bit more, and then versus even taking your profit, you want to do that, but that you can more manually manage. Where stop losses can occur quickly, so it's good to put a stop loss order in. And then once you've decided on all that type of ordering stuff, then it's time to just you place your order. You hit the buy button in this case, in the example, and you now have opened a position, right? So it's out there. It's opened a position. Now you're watching the market and monitoring it and seeing what's happening. Which direction is it going? Is it going up or down? And then when you're ready to close that position, you basically just make a trade in the opposite direction of the way that you opened it. Remember, you can buy or sell Forex. So if I bought, then I would sell to close my position. If I sold, if I was short selling, if I was selling, I would buy the same amount and the same currency pair to close that account out. So the good news is most online Forex brokers, you don't have to try to calculate that or try to remember or anything. You can just basically open up that position, and there'll be a button that says close position. You just hit that button, and then it automatically takes care of it for you to place a trade in the opposite direction. And then again, the difference, once everything's said and done, is either your profit or your loss. So that's kind of what you're doing as far as doing your first trade, and some of the considerations you'll be looking at from either setting up orders and walking through the whole process. Again, paper trade, you'll be able to practice all this stuff and then start small when you're doing with real money. Okay, we've learned quite a bit now in a real quick amount of time. Let's walk through a trading example step by step, and I'm just going to walk everything through, and at the very end, we'll have a nice summary slide too. So we're going through it and you're like, I'm not sure I'm getting all of it. Don't worry, we have a nice summary slide at the end that makes it actually easier to understand as we walk through it. Also, because the Forex pricing is constantly changing every second, don't worry about the pricing in this example. Just use it as a guide as far as whether we're making money or not making money as we walk through the example. So let's take a look at this example of a trading Forex example. So let's say in this example that we're going to trade the euro to the US dollar, right? And it's trading at, so you can see at 1.11280, all right? And then we have a spread, right? So we have a buy price of 11284 and a sell of 11276, right? So that's our spread. And you can probably see, look at the fourth decimal point and our pipettes, our smaller pips, that we have a spread of 0.8 pips, right? We don't even have a full 1 pip spread. It's a 0.8 pip spread. So it's pretty low cost actually in terms of spread. So if we want to buy, we would be buying at the 1.11284, right? That is the buy price, as far as buying the euro in terms of value against the dollar. So that's what we're going to do in this example. We're going to buy some euros. All right, so then we're going to look at the position as far as the size, and that's measured again in lots, and a standard lot was equal to 100,000 units of the first currency, the base currency in the pair. So that'd be 100,000 units. So in this case, buying a single lot of this pair is the equivalent of trading, 100,000 euros for $111,284 is the idea. Because again, if this was if it was like point something, then it'd be a lower number as far as in the dollars. But since the euro in this case, in this time, is stronger than the dollar, we're looking at trading at that 1.11280 with a buy price. That's the quote price, but we're basically buying at 112.84. Thus, our 111,284 to trade for those euros, and we're hoping those euros will go up in value. All right, of course, we don't have $111,000 laying around, so that's already pretty expensive. But let's say we don't want to stop there. We want to buy 3 standard lots. All right, so now we're just really going in, right? We want to buy 3 standard lots. So our total position is going to be $333,852 in dollars, because we've got 3 100,000 euro lots, right? So that means that we're going to earn $30, because it's 3 lots, and don't worry, there's a summary at the end. We're going to walk through this. We're going to earn $30, the equivalent of $30 for every 1 pip movement, right? Or 0.001 US dollars, right? So at the 4th decimal point. This is called your pip value, by the way. So, all right, so we're going to exposure to quite a bit of money, and our every pip's going to be worth $30 to us. Now, since Forex can be a leverage product, you don't have to come up with $330,000. So let's say with our online broker, let's say they have a margin factor of 2%. So all I would need to commit to get to this, or a deposit, or my margin, would be $6,677, or 2% in 4 cents, to give me the equivalent of 6,000 in euros as margin. So basically, I'm investing a little over $6,600 of actual real money, margin, deposit, to have an exposure position of $330,000 in euro, and then the equivalent in euros to earn profits on, is the idea. We hope it goes up. So let's say our prediction is correct. Yay! And the dollar appreciates against the euro. And let's say it's now trading at 1.11530 with a buy of this and a sell of that, as you see. So you would reverse your trade to close your position, or close out the position. So you would sell the 3 lots, and you'd do the opposite and close that out, and you'd be selling at 1.11526, right? So that's what we're selling at. So my 300,000 euros is now worth 334,578 in dollars, because we had 3 lots. Don't worry, we'll have a summary slide. This will be real easy at that point. Just hang in there for now if you need to. But the difference in price between what we bought and what we sold for, the profit we made was $726. Because we used that leverage, we're able to get $726, the equivalent of that. Basically, it moved up 24.2 pips, and we had $30 per pip because we had 3 lots. Remember, we bought 3 standard lots, so that's our $726. Now, if we didn't sell, or if we wanted to keep that position overnight, then there's some funding charges, Tom-Next charges. There might be some carry charges like that. Plus, you pay taxes on your profits. So again, this is not a tax course, but you pay taxes on your profits. You obviously don't pay taxes on your losses. So some thoughts to think about. But the good news is we made money, right? Because we bought at 1.11284, and it went up to a higher amount. So when we close the position, we're closing at 1.11526. That's the sell. To reverse it, to close the position. So we made our $726 in profit. Look at that. Isn't that great news? All right, so let's say the prediction was wrong. Let's say it didn't go the way we expected. And the dollar strengthens against the euro. We thought the euro was going to do good against the dollar. It actually went the opposite way. So it's trading at a different buy and sell price now, a lower one for us. So we have our 3 lots, and now we're at 333,078. So our lot units are now worth that $333,078. Or $774 less than what we opened the position at, right? And there's different ways you can calculate that, just basically on the pips too, by looking at the pip value and doing it that way to make it easier. But in the end, we lost $774. It didn't go the way we wanted to. Graphically, we can look at this and see, okay, we opened our position at 1.11284. Market moved down 25.8 pips. And so we ended up, having to reverse that out and basically reverse that out at the lower amount, and so we had a $774 loss, right? Is what we had, because we bought, now we had to sell, so we're selling at 1.11026. So there's an example of the loss. Okay, so we went through that pretty quickly. Here's the summary slide here that I'll walk through it. Feel free to pause here, take a look at that to try to work through it in your head a little bit. But just to kind of summarize here. Let's walk through this thing. This is the same stuff we already talked about. We're just going to do a summary now. So the underlying price, what you might see as that kind of price out there, is that 1.11280. And you can see we have a spread. So we have a sell and a buy price, that are different than that underlying price. So we decided in this case, for this example, not to sell, we decided to buy. So we bought up to 1.11284. And we bought 3 lots. And you can see our initial outlay, or our margin, was, because we needed a 2% margin, was $666,677.04. By the way, if our margin requirement was higher, like 3 or 4%, we would have had to come up with bigger amount of money as far as that initial outlay to have exposure to all that 3 full standard lots. And then it walks it right through as far as profit and loss, that if it rose 25 pips, what happens? If it drops 25 pips, what happens? And kind of the calculations behind that, so you can kind of see this and walk through that on your own there a little bit too. But as you can see, we have either if we profit of 726 or we had a loss of 774. And again, with leverage, we're magnifying that, right? We're not buying a total of $333,000 in total. We're only putting up $6,677 to get those 3 standard lots, to get that leverage. But again, that can magnify profits and it can magnify losses as well too. So that's an example of how, a basic, simple walkthrough as far as, just that you can do yourself and start with paper trading, that you can do to buy and sell, in this case, buy foreign currency. So we think about just kind of general concepts around Forex trading strategies and what might be a good Forex trading strategy, because it can vary by every individual. Every person is different. So some good ideas to get you thinking about as far as how you might want to trade Forex. So first off, a Forex trading strategy should take into account the style of trading that best suits your goals and your time that's available. So for example, day trading is a strategy that involves opening and closing positions within a single day. So you never have anything that you're carrying overnight or have any carrying costs or time next costs. You're doing everything in that one day. And you're taking advantage of small movements in the price of a currency pair each day. And that can certainly add up over time, especially if you're trading many, many pairs in a day. And you can put as much time as you want into that. If it could be full-time day trading, or maybe you're day trading for shorter periods during the day. But the idea is that you're closing all your positions and you're not carrying anything over. Another concept is called position trading, and that's a strategy of holding positions open for a longer amount of time, to take advantage of more longer-term trends or longer-term major price movements. Maybe you think a certain economy is, struggling, and you think it's going to just keep struggling for a long period of time. Well, maybe you want to be more of a position trader and let that kind of ride or run for a longer period of time. So both have different types of time commitments and different techniques you might use for success. A day trader, for example, would be very heavy around technical analysis. So position traders can use technical analysis too, and I would certainly recommend it for either one. But certainly day traders are going to really focus on that, as well as events that might be happening in the news. Both can look at that, but those small price movements can be magnified for a day trader if some news comes out, good or bad. Also, you want to think about your comfort with risk when you're thinking about your overall trading strategy. How much leverage do you want to use? And again, as you become more comfortable with trading, you might want to start using leverage in the first place, or you might want to start using more leverage if you're starting to get comfortable with leverage. Again, that's going to develop over time for you, but start small, start slow, and then you can keep using leverage, and that'll help determine your strategy around how comfortable you are with risk. And then also thinking about fundamental analysis and technical analysis, or a combination of both, or hybrid, where maybe you're looking at the news, but following things around that way, around central banks, but then you're using technical analysis to decide whether you're going to actually make the trade in that moment of time. So you're kind of using both in conjunction. And then learn more about those different types of analysis techniques, fundamental analysis or technical analysis. Keep learning more around those. So those are some strategies or some thoughts really to kind of get you thinking about it. But the key thing is to have fun with it, and you're going to keep learning as you go and keep applying the concepts you learn in this course and the concepts that you're learning as you're actually doing some actual trading. You'll get better each time. You'll become more comfortable each time. And your actual trading style or strategies and things will actually develop as your trading experience increases. And that's a really good thing. Congratulations, you finished the course. That's so terrific. That's so great. You're getting ready to start investing in Forex. I'm so happy for you. So let's talk about 4 key action steps to take, plus a bonus step as well. So first step is just start thinking even more about what type of trader you want to be. How often do you want to trade? What kind of currency pairs interest you? Just kind of start thinking about that. So that's step number 1. Step number 2, which I think is real important, we've talked about before in the course, is set up that free trading account. Free paper trading account, also known as a demo account, so you can kind of start practicing a little bit and playing around with it and enjoying it without having to risk any money. Next, and this is a key one too, is continue your education. I think it's so important to keep learning and to be a lifelong learner. That might involve taking like a technical analysis course. I hope you take my technical analysis course, but if not, take something if you want to trade Forex, especially if you want to get involved in technical analysis, or other types of courses might be out there. Fundamentals, pretty much you just want to learn and understand, like, well, when interest rates rise, what might happen, that kind of stuff. That's pretty easy to actually kind of figure out pretty quickly. It's technical analysis where you might want to invest a little more time in, and maybe take some additional courses around that. Start learning about different order types and all that kind of stuff and see what fits you. Stop losses, take profits, market orders, all those things. And your overall just kind of strategy and education around your strategies and philosophies on how you might approach it. And the 4th step is basically to take action, right? Just to start doing stuff, do your demo count, and start taking action. And the bonus step, more real favor for me and other students, is to leave a review. That would be really great if you left a review. It helps me out, helps other students think whether this course might be for them. So if you like the course, or you learn a couple concepts, leave a review, leave a top review, be a 5-star review. That would be great. Either way, leave a review. That'd be really appreciated by everybody, me and other future students. And then lastly, I just want to conclude and wrap up the course by saying thank you. Thank you so much for spending time with me. Thank you for learning about Forex and continue your education. And with that, that concludes the course, and I wish you all the best of luck in your future endeavors and maybe in your future currency and Forex trading.